Okay, we are recording. So this recorded lecture, we're going over chapter 2. And chapter 2 deals with material cost and how we do some of these calculations and then the journal entries to record material transactions. So not too bad, I think. I'm going to share my screen with you and get the chapter 2 PowerPoint pulled up. And so, oh goodness, let me hide my face so I'm just not staring at myself the whole time. Okay, so chapter 2, accounting for materials. So again, the cost control system and how we put controls into place to determine these costs and to control material cost is that there's always, the separation of duties, a specific assignment of duties and responsibilities, a list, and whether this is, the purchasing manager, the stockroom manager, the production manager, right? Each one has its own duties and responsibilities associated with material controls, right? List of individuals who are authorized to approve expenditures, and then an established plan of objectives and goals. And that's where our budgeting process comes in. So the two basic aspects of material controls are the physical control or safeguarding the assets, and then control over investments or the purchasing of materials, right? So that's kind of what we're going to talk about with each one of these. And as we mentioned with the physical controls, some of the things that we put into place, for example, limited access to the stockroom, or segregation of duties. So maybe the person that is authorized to purchase the material is not the same person that is receiving and counting the materials, for example. And then accuracy in recording. And then on the investment side, we look at order point and then economic order quantity, which we are going to talk about further and get practice with together. So again, when we think about physical controls, and I know I just mentioned this a moment ago on the previous slide, physical controls, limited access. Again, only authorized personnel should have access to the material storage areas. And then also there should be procedures in place within the production area for safeguarding work in process. And then also finished goods should be safeguarded in a limited access storage area and not be released for shipment until the appropriate order documentation has been put into place. So again, segregation of duties, just generally speaking, and I know we've talked about this before in previous accounting classes, but that segregation of duty is really, we think about like an arc that protects us. So ARC, A-R-K. So authorization, recording, and control, those three things should be separated out. So if the purchasing manager has authorization to order the materials, the accounting department has the ability to record the transaction. And then the stockroom manager has control over the materials, for example, right? Segregation of duties, and just like it tells us in our book, and just like we've read in other accounting books, I mean, we could have the segregation of duties in place and, there could still be the potential for misappropriation of assets or misuse of assets, but certainly the segregation of duty cuts down on that. And then accuracy in recording. And again, in investment controls, when we think about investment controls, we want to keep sufficient levels of raw materials, however many raw materials we use in the production process. We want to have those basically, those levels determined, sufficient levels of each materials that need to be kept on hand, or the safety stock. And then determination of the order point. Again, the order point being the point at which an item should be ordered. So once we reach a certain level, then it should be reordered. And the order point relates to the usage, the lead time, and the safety stock. The usage is the anticipated rate at which the material will be used, so how quickly the material's used. The lead time is the estimated time interval between the placement of an order and then the receipt of the material. So basically how long it takes the order to get processed, shipped, and received by us. And then the safety stock, again, the safety stock is the estimated minimum level of inventory needed to protect against stockouts or running out of stock. And, you know, as you can imagine with materials, you know, raw materials, we don't want to stock out because then that halts the production process. That stops the production process. So we always want to have some of that safety stock consideration as well. All right, the economic order quantity. So the economic order quantity is the optimal quantity to order at one time. The order size that minimizes the total order and carrying cost over a period of time, such as 1 year. And so to calculate, and I think we see the formula, and you know, it just drives me crazy when I see like this doesn't have the parenthesis on it, but whatever. These PowerPoints came out of your book, so that's not a mistake that I made. We calculate the economic order quantity by taking the cost of placing an order, the number of units required annually, and then the annual carrying cost per unit. I think we see that formula on the next slide. But like it shows here, it minimizes the total order and carrying cost over a period of time. So when we think about some of those order costs, we think about purchasing, receiving, and inspection, wages, telephone and fax charges, software, postage, and stationery, accounting and record keeping. When we think about some of the carrying costs, storage and handling cost, interest, insurance, property taxes, theft, spoilage, obsolescence. So again, the economic order quantity helps us to you know, bring that information together to determine the optimal quantity to order at one time. Taking into account, of course, any trade discounts or, you know, order discounts and things like that that we get as well. All right, so here is the formula for the economic order quantity. Again, we take cost of placing an order, the number of units required annually, and then the annual carrying cost per unit of inventory. The formula looks a little funky, but it's not too bad. We'll get practice with it in class together. And you can see an example of this in, or in your book, chapter 2, page 73 shows an example with some numbers plugged in. But again, we'll get practice doing it together as well. All right, so material control procedures, you know, again, as we mentioned before, these control procedures are put into place to control not only the purchase of materials, but then when the materials are received. So, you know, again, we have an authorized person that's, you know, authorized to purchase materials, and then it should be somebody different, like a stock room or a storage room manager that would receive the materials and count them and make sure that they match the purchase order and the amount purchased, right? And then we'd also want the storage of materials, limited access to the stock room or to the storage facility. And then we also have procedures in place for materials requisition and then the usage or consumption of materials. And generally speaking, it's, you know, somebody within the production facility, whether it's the production facility or manager, that would have authorization to request materials through the use of the materials requisition slip. All right, material control personnel. Again, we've talked about these already. So the purchasing agent, the receiving clerk, or the storeroom keeper or stockroom keeper, the production department supervisor, you know, so you think about the purchasing agent would fill out the purchase order, and that would be used to purchase the materials. And then the receiving clerk would make sure that the materials received match the purchase order. Of course, the storeroom keeper would be in charge of the inflow and outflow of materials. And then the production department supervisor is who would, in most cases, fill out the material requisition slip to request materials to be used in production from the storage facility or the stock room, the storeroom. So here kind of shows an overview of that, or kind of how that flows through the system. So storeroom keeper, you know, we're getting low on materials here. So then they notify the purchasing agent. The purchasing agent prepares the purchase order and sends a purchase order to the vendor. This is who we're purchasing the materials for. So the vendor prepares the order and sends an invoice. The accounting department records the purchase of the materials. And then generally speaking, once we receive the materials, right, the receiving clerk prepares a receiving report that then should match with the information within the purchase order. And it kind of shows us, again, some of those documents commonly used throughout the procurement process. So purchase requisitions, purchase order, vendor invoices, receiving reports, and if necessary, debit or credit memos. So here's an example of a materials requisition slip. So again, this materials requisition slip would have been probably filled out by the production manager, the production facility manager, requesting these materials to be used in production, and that materials requisition slip would go to the stock room or to the storage room. We can see down here that we have approval by a couple different people, issued by, received by, so that there is, again, those separation of duties and you know, several eyes on it, right? All right, so accounting for materials, you know, ultimately when we think about our material ledger accounts, you know, our material ledger accounts, the amount of materials that it shows on our books, in our accounting software, is made up of the quantity that we have of material and the cost per unit. So if we know the quantity, how many units we have, and the cost per unit, right, that's where we get our material cost from. That's how we know how much we have in. That's what would be listed in our accounting system, and then that's what should match what's on the shelves, right? And just like it shows here, the materials accounting system is integrated with the general ledger, so that you know, if you know, for example, if we find out maybe that we have some defective units, or we have some units that we're not able to sell, they're defective, then we would adjust the materials accounting system, which then should also adjust our general ledger. They should be integrated together. And then, as we probably know at this point from doing journal entries similar to this in the past, the purchase of materials on account are recorded as a debit to materials, and then generally speaking, credit to accounts payable, right? All right, so the materials account is supported by the materials ledger. So, you know, again, if we have, say, 5 different raw materials that we use in the production process, you know, maybe, you know, thinking about the bicycle example that we looked at in the last chapter, you know. So maybe we got a materials ledger account for tires. We've got a materials ledger account for the frame. We got a materials ledger account for brakes. We've got a materials ledger account for you know, the little baskets that go onto it. We've got a materials ledger account for the chain and the pedals or whatever, you know. So those material ledger accounts, you know, the combination of all of those materials makes up our material control account, right? And so just like it shows here, the flow of materials is the order in which materials are actually issued for use in the factory. So we purchase materials and then materials are sent to the factory to be used. And the flow of cost is the order in which unit costs are assigned to the materials issued. So, you know, whichever materials, say, you know, and I don't know what bicycle manufacturing prices are, but let's just say, for example, that our bicycle frame, the frame for our bike is $10 per unit, right? So, you know, we requisition, or the factory request, you know, 100 bicycle frames for the production process, and each one of the bicycle frames costs $10. So then that's going to be $1,000 worth of material sent to the production facility or to the factory, right? The cost and then the actual units itself. All right, so there's 3 cost flow methods. First in, first out, last in, first out, and then the average cost method. I don't know, in this book they say moving average method. You know, it's funny because I've heard it in different accounting textbook called different things. So weighted average method, average cost method, moving average method. You know, these are our 3 main cost flow methods. So FIFO, first in, first out. LIFO, last in, first out. And then again, that average cost method. So FIFO, first in, first out, means the goods that are purchased first are the first to be used in the production process, okay? The goods that are purchased first are going to be the first to be issued to the production process. In other words, the older materials that we have are going to be the first to be used, right? The goods that were purchased first, or the materials that were purchased first, are the first that are going to be used in the production process. And we'll look at an example of this in the next few slides. All right, last in, first out, LIFO. The materials to be purchased last or most recently, the materials to be purchased most recently are going to be the first to be issued to the production process, right? So last in, first out. And you know, there are examples of when last in, first out makes sense for some companies, although most companies use first in, first out. And then the moving average method, basically what we do with the average method, the average cost method, the weighted average cost method, the moving average method, is that we calculate an average cost per unit, weighted average cost per unit, so that, you know, it doesn't necessarily matter if the units are older units or they're purchased more recently. We're going to calculate a weighted average cost for every unit. So those are going to be the cost assigned to each unit. And so the next few slides shows us examples of each one of these. So here's an example of FIFO. And so we're thinking about FIFO, December 1. We've got, and so this would be like our beginning inventory, right? We've got 1,000 units that cost us $20 each. So at that time, our material cost or our material balance would be 20,000, right? Now, December 10th, we've issued 500 units to the factory. Again, these units had a cost of $20. So then the amount issued to the factory was 10,000 worth of material. And then the remaining balance, what's left, again, we had 1,000, we used 500. So now we've got 500 left at $20, which has a balance of 10,000 left in our materials account. All right, now December 15th, we purchased 1,000 units, $24 per unit. So that purchase was a $24,000 purchase. And so now the balance of our account, we've got 1,500 units. 500 of them cost $20 each. 1,000 of them cost 24 each. If we do the math on that, that's 34,000 total in our material account, right? Now on December 20th, we use or we issue 250 units to production. So those 250 units, oh, you know what? It just skipped to hot dog. It skipped to LIFO. It wasn't supposed to do that yet. Nice. I'm supposed to be back here on FIFO. Okay. December 20th, we issued 250 units. So those 250 units are going to come from the older goods, from the 500 left from the beginning inventory. So we issued 250 units. They had a cost of $20 each. That's 5,000. And so now we had 1,500. We used 250. So now we're down to 1,250 units. Of those 1,250, 250 cost $20 each. 1,000 cost 24 each. If we do the math on that, that means we've got total materials of 29,000. All right. Now, December 26th, it looks like we use a total of 500 units. Of those 500 units, we're going to use 250 of them that cost us $20 each, 250 that cost $24 each. So we used 500 units. We had 1,250. We used 500 of them. So now we're down to 750 that cost $24 each, leaves us a balance of 18,000 in cost. All right, now December 28th, we purchase 500 units at $26 each. That's a cost of 13,000. So we had 750. We just made another 500 unit purchase. So now we're up to 1,250. And of those 1,250, 750 of them cost us 24 each. 500 times 26, we do the math on that. Now we've got balance of 31,000. And then lastly, December 30th, we issue to production 500 units. So of those 500 units, we're going to go back, and again, we're going to use these older units first. So we're going to use 500 out of this that cost $24 each. That's a total of 12,000. And so what's left, we've got 750 units left. 250 of them cost 24 each. 500 cost 26 each. So we do the math on that. 250 times 24, 500 times 26, we've got 19,000 worth of materials left in our materials account, right? That would be our ending inventory in raw materials. Okay, LIFO, on the other hand, last in, first out. The goods to be purchased more recently are the goods that are going to get used first, basically, right? So the first two lines of this, December 1st, December 10th, are exactly identical to FIFO, right? Because all we had was this beginning inventory to sell or to use in production. All we had was this beginning inventory. So when we sent 500 units over to the factory, they had to come from here. There was nothing else to choose from, right? So the exact two, the first two dates on here, December 1, December 10th, look exactly the same as LIFO, or FIFO rather, look exactly the same as FIFO. The difference comes in here now when, and actually I guess I could say the first three lines, because the purchase would be the same as well. So December 1st, December 10th, December 15th, these look exactly the same as with FIFO, first in, first out, right? The difference comes when we use some of these, right? So now December 20th, we issued 250 units to production, but instead of going back and getting these 250 units from this beginning inventory, we're going to take these 250 units from this most recent purchase. So we're going to use 250 units. It costs us 24 each. That's 6,000. Now we don't have 1,500 units left anymore. We just used 250. So now we've got 1,250 left. Of this 1,250, we've got 500 that cost us $20 each, right? The same 500 we had left over up here, right? 500 that cost us $20 each. And we used 250 of this 1,000. So of that 1,000 now we've got 750 left at 24 each. So we do the math on that, 28,000 is what our inventory account would show, our material inventory, raw material inventory, okay? And then same thing here, December 26, now we use another 500, but instead of going back and using these 500 at $20 each, we use the 500 that cost us 24 each, so that's $12,000 material cost. So now we've got 500 left. This is, hot dog. This is supposed to say 750. We got 750 units left. 500 at $20 each, 250 at 24 each. We do the math on that, 16,000. Here we make a purchase, 500 units at $26 each, cost us 13,000. Now we're back up to 1,250 units. Of those 1,250 units, 500 of them cost us $20 each, 250 of them cost us 24 each. And then this purchase of 500 at 26 each, we do the math on that. We've got material balance of 29,000 in cost. And then December 30th here, we send 500 units over to the factory. Again, we're not going to send the 500 units from way back here in our beginning inventory. We're going to send 500 units from this most recent purchase. So 500 units cost us $26 each, so 13,000. So now, you know, again, we had 1,250 units. We used 500 of them. We've got 750 units left. Those 750 units are made up of 500 units that cost $20 each, 250 units that cost 24 each, and our ending balance in raw materials, 16,000. All right. The weighted average method. Again, what we do with the weighted average method is after each purchase, we have to calculate a new weighted average, right? So, you know, with the weighted average, there does tend to be, you know, several calculations of the weighted average throughout the period, but luckily accounting software is equipped to do the math on this for us, right? But I did put an example of how we do the math on it. We will get practice with it together. But again, you think about the first two lines here with weighted average, exactly the same as with FIFO and LIFO. We had 1,000 units to begin, $20 per unit was a total of 20,000. And then we issued 500 units to the factory. These 500 units cost $20 each. And so we issued materials worth $10,000 to the factory. What's left over, our balance, we've got 500 left at $20, which would be $10,000 in cost. Now, here's where now we've got a purchase. So now after this purchase, we have to calculate a new cost per unit, a weighted average cost per unit. So now we purchase 1,000 units at $24 each. And so that's 24,000. So now what we have to do to calculate the weighted average is we've got, and look down here at the bottom of the screen here, we've got 500 units at $20 each. That costs 10,000. Plus 1,000 units at 24 each, that costs 24,000. So we add together 10,000 plus 24,000, so 34,000, and that represents the cost of 1,500 units. So we're taking our 34,000 divided by 1,500, which gives us that average cost of 22.66667 per unit, right? That's what they're showing us in our textbook, right? So 1,500 units times 22.666667, 34,000, right, is what our material cost would be. And so now when we send these materials to the factory, 250 here, 500 here, we've got that average cost per unit. We can calculate the amount based on that, and we can calculate our ending inventory based on that, right? However, December 28th, we purchased 500 units at $26 each, 13,000. Now we've got to calculate a new average cost per unit. So essentially, after every purchase, we calculate a new average cost per unit. So, don't worry if this doesn't make 100% sense just looking at the PowerPoints, because we will get practice with it in class together, and we'll get practice calculating this together. And I know for some of you, definitely those of you that took intermediate accounting last semester, or last school year rather, we got a lot of practice with FIFO, LIFO, and weighted average. So hopefully that makes okay sense to you. Okay, comparison of the inventory method. So FIFO, LIFO, average cost methods, these are all three, generally accepted accounting principles, or part of our generally accepted accounting principles. But depending on which one a company employs, their ending inventory and cost of goods sold, in this case, just the material cost, because we're just focusing on materials cost, but ending inventory and cost of goods sold will be a little bit different depending on the method. And then also gross profit will be a little bit different depending on the method. So just kind of keep that in mind. Each one of them is an acceptable way to do it, but FIFO is used more often. All right, so this just kind of shows us, and I forget what chapter, what page this is on in your textbook. I'm trying to find it real quick. This is on page 97 of your textbook. And so this just kind of shows us how each of these documents and each of these accounts are kind of related. So if we think about here again, here are three main kind of manufacturing costs, right? Materials. Well, I guess no, they're not showing us labor here. So they're showing us the material account. They're showing us work in process. They're showing us the overhead account. So, we get, for example, we see our storeroom employee, or our storeroom person sees that we're getting low on a material, and he or she fills out this purchase requisition, which then is sent to the purchasing department, and that's what the purchasing department used to fill out a purchase order, place an order, right? So the purchase order, then a copy goes to the vendor, a copy goes to wait with the receiving report, right? Because once we receive these, we want a copy of the purchase order to go with the receiving report, right? So then from that purchase order, we're able to adjust the material account, right? We're able to give that purchase order, hopefully with an invoice attached to the accounting department. This is how our materials ledger and our purchasing journal gets updated. And then from the factory, whether it's the production manager, whatever, request the materials requisition then affects the materials ledger and is deducted from the materials ledger. And just kind of how each one of these flow to each other. The material summary, direct, indirect. Remember, direct materials get debited to work in process. Indirect materials get debited to factory overhead, and we got practice with those journal entries in chapter 1, and we'll continue to get practice more with them when we work on our exercises in this chapter as well. All right, so just-in-time manufacturing, or the just-in-time inventory system, or what is also known as the lean manufacturing or lean production system. Basically in this system, or this type of system, companies do not keep a large amount of materials on hand. Essentially, the materials would be delivered basically as soon as we need them, right? So, I mean, as you can imagine, it requires an incredible amount of cooperation between vendors and suppliers to make sure that materials are there, right when we need them, right? All right, so just-in-time manufacturing is considered pull manufacturing, and hopefully these illustrations help to show that to you. So this is kind of the traditional push model, right? So the traditional push model, it starts with purchasing. We purchase the materials, they're put into the storeroom, and they're kept in the storeroom until we need them. Once the production plant needs them, then they're sent over to that production department. Okay. And then once they're finished is when they're sent to the finished goods stock room. So, you know, here it's showing us two different departments: cutting and assembling, testing and finishing. That's fine. It doesn't matter. The materials are pushed through the production process, right? It starts with purchasing, and then they're pushed through the production process as needed, okay? Where in a pull system, as we see down here with the just-in-time manufacturing pull system, it starts with the sale, right? Instead of having a finished goods storeroom and waiting for these goods to be sold, with just-in-time a pull system, it starts with the sale. Once the sale is made, or once the order is placed for the product, then it goes through the production process. It's pulled through instead of pushed through the production process. So, you know, what we need for testing and finishing would be delivered. What we need for cutting and assembling would be delivered when necessary. And then purchasing would make purchases based on the request from cutting and assembling department, or request from testing and finishing department. So, all right. So a few of these definitions, or a few of these terms we need to know: the throughput time, the velocity, the non-value added activities. You know, these are some of the things that just-in-time manufacturing or just-in-time production system, whatever you want to call it. You know, these are a few of the things that just-in-time manufacturing helps to alleviate or helps to control. So the throughput time, the time it takes a unit to make it through the manufacturing system, it helps to alleviate the times on that. And in fact, your book gives us the example of reducing the throughput time, for example, from 4 days to 1 day with just-in-time manufacturing. Just-in-time manufacturing increases the velocity, or the speed at which units are produced in the system. And just-in-time manufacturing helps to reduce the non-value added activities, such as, you know, moving materials around, storing materials, inspecting inventories, things like that. All right, so finally, our chapter ends with talking about and showing us how we account for scrap materials, spoiled goods, and then defective materials or defective units. So scrap materials may result naturally from the production process. Your book gives us, and this is why I say you should read the chapters, because your book gives us a lot more information than what I can remember to tell you going over the PowerPoint. But your book uses the example of Subaru, and I forget what they said, and I'm trying to flip through and see if I can find the exact number for you, because I thought it was a really cool story. Subaru started, and I can't find it now that I'm trying to go through and find it real quick here, but your book tells us about an example of Subaru. Oh, I just found it here on page 104. And your book tells us that the Subaru plant in Lafayette, Indiana, by essentially recycling their scrap materials and reusing what they could, it reduced the amount of material waste, and it recycles 99.3% of excess and leftover steel, plastic, wood, paper, and glass. So I thought that was a really cool, you know, especially as we get more into talking about sustainability and environmental impacts and things like that. I think it's really good for companies to be able to recycle and reuse these scrap materials, or at least sell them maybe to a recycling plant that then can recycle them and reuse them in some way. So how we deal with those journal entries depends on how valuable the scrap materials are. You know, if it's an immaterial amount, there's a way we deal with it versus if it's a larger material amount. Spoiled units are units that have imperfections that cannot be economically corrected. The loss can be treated as part of the cost of the job or as charged to factory overhead, again, depending on the situation. And then defective work are units that have imperfections that are correctable. The extra cost are either charged to the job or factory overhead. So, you know, a couple things, just like your book tells us, and again, we'll get practice with this when we work some of these together, but you know, we can either, because the units are defective, we can reduce the cost of the unit to the consumer, or we can put in the extra time and money, the extra time, material, labor, overhead. We can put in the extra money to correct it, essentially. And it shows us examples of both of those in your books, and we'll get examples with both of them together. So hopefully, okay, let me stop sharing this. Hopefully, hi there. Hopefully that gives us a good overview of chapter 2. You know, again, I'm going to do a recorded lecture for each chapter, so that frees up class time to focus on doing some of these calculations and some of these journal entries and things like that. Better hands-on practice, right? So after viewing this, please let me know if you have any questions, and I will see you guys soon. Bye-bye.